Welcome to another video. My name is Tom Nash. Welcome to the Stock MVP Stock Review, and today we're looking at Apple. Now, opinions on Apple are kind of like buttholes. Everyone has one, so there's a lot of ranging opinions about the stock. And in today's video, we're going to put some objective numbers on it. Now, of course, I will be using my own platform called Stock MVP, which we are on right now, and you can get it as well if you haven't yet. The details are going to be below. Obviously, part of the reason for me doing this video is also showcasing the platform, but I also want to give you a lot of value here. So let's look at Apple stock right here from the main menu, and let's see what's going on with Apple. One of the most searched stocks on our platform recently, and very highly requested by you guys. So basically, Apple, and I'm going to go to advanced look right here because I want to see what's going on with the stock. Over the past year is down 30%, just under 30%. Underperforming the S&P 500 slightly, but not like some of the other tech stocks we looked at recently. So kind of tracking the S&P 500 just a little bit lower. On the classic look, I can see that our short interest for the stock is almost non-existent. Beyond this 0.77%, nobody's shorting the stock. So right here and then, you can see there's not a lot of short activity on Apple. I mean, it's not a highly shorted stock. It's never been, Now I want to take a look at my own personalized cards right here. These are called our MVP cards. You can create your own and customize it with whatever information you want. You can click on this button and choose one of these categories to showcase. This is my own specific one, but you, when you use this platform, can use your own specific cards. Now, looking at the cards, there's a few things that pop out here. Look, we're talking about a mega cap stock, right? Not a lot of secrets with Apple. You can see that, their revenue is at 394 billion. The one thing you would notice here right off the bat is there's definitely a slowdown. I mean, over the 5 years period, they grew by 72%. Over the past 3 years, 51.5%. Last year, they grew by just under 8%. So it's starting to slow down, but a lot of the industry is. I mean, post-pandemic, high interest rates, recessionary fears, a lot of it is consumer goods. Even though it's a cult brand, they're also feeling the pain, but still, nice 8% growth for one of the largest companies in the world. It's not bad at all. 400 billion of revenue. I mean, nobody will say no to that, right? So selling and general and administrative expenses are 25 billion. Okay, so look at this. Over the 5-year period, it grew by 64%. Over the past year, SG&A grew by 14%. You never want to see growth in expenses, especially SG&A, which is higher than your growth in revenue. So revenues grew by almost 8%, but SG&A alone grew by 14.2%. And if you look at operating expenses at 51 billion, they grew by 17%. So our growth for operating expenses is double than revenue growth. And it's not always a good situation to have. It means that, the company isn't generating as much, it isn't accelerating its revenue growth as fast as expenses are growing. And that's understandable. Inflation, cost of goods, cost of materials, cost of employment, everything goes up. It's kind of, every company that you're going to look at right now, you're going to see this pattern. This is nothing unusual. So looking a little bit deeper here, let me make the screen a little bit bigger so you guys can see what's going on. EBITDA is at 133 billion, not bad at all. Annual growth of 8% in EBITDA, not bad at all. Net income of 100 billion. Don't know a lot of companies that can give you net income of 100 billion a year. Net income went up by 5.4%, which means that at the end of the day, they still made money and they grew. Not bad at all. CapEx is at 10.7 billion, pretty much flat over the past few years. Past 3 years, it's down 2%, up 3% over the past year. So CapEx is kind of flat. Free cash flow of $111.4 billion. Massive, massive, massive. And look at this. Growth of the past year, 20%. Of the past 5 years, 120%. So the company is literally printing money, and it's printing more of it every year, pretty much. The balance sheet of this company, again, is something we have to look at, and then we'll look at the ratios. So the first thing I want to show you here, if you don't want to look at the specific things yourself, all the data for the company is right here. You can look at all the financial data yourself. You don't have to screen it with these cards, but that's easier to use the cards. So look at the total liabilities right here, $302 billion. Total assets, $352 billion. Not the best ratio we've seen, but they still have more assets than liabilities, which in my book is good enough. Not amazing, but good enough. If you look at total debt, they're sitting on $120 billion of debt. Considering the fact that they have $20 billion in cash, That's never like an optimal situation. To have 6 times more debt than you have cash, not amazing. But given the fact that they're generating what $114 billion in free cash flow, I think they're good for it. So I don't think this is a concern given the amount of cash these guys are generating every year. But never like to see 6 times more debt than cash. Price to book ratio is 40, which is absolutely insane. Price to sales is 5. And as you can see right here, price to earnings is 20.3. So it's priced, if you use Tesla as a benchmark, Tesla is priced right now at a little bit under 30 with price to earnings. So it's actually, let's take a look at Tesla right here, just so we can take a look at the benchmark, right? Because Tesla is kind of considered an expensive company. So it would be a good comparison for us. So let's go to the cards below. So Tesla is trading at 32 price to earnings ratio. So 32 price to earnings ratio for Tesla, and Apple is trading currently at 20.3. So trading much cheaper than Tesla. Let's put it this way. Not an expensive stock if you compare it to Tesla, but not a cheap stock if you compare it to average stocks. Looking real quick here at DCF. Let's take a look at the DCF right here real quick. So let's put in some basic assumptions. Let's give them the 8% growth we've seen earlier, just as a benchmark. We're doing a general DCF. This is not a professional DCF. We're going to give them depreciation amortization growth of about 2%. CapEx growth, again, about 2%. We're going to populate. We're going to calculate it with 4%. Long-term growth, 12% discount rate. And what we get here is this stock, at least based on this very simplistic DCF, is valued at $100, $101, which means that at 126, it's overvalued by 20%, almost 20%. And at the end of the day, look, at this kind of market, you want to try to get a bargain. And things are not good and not getting any better in 2023. So you're looking for the bargains. No doubt, Apple is a terrific company in any stretch of the imagination. I'm not going to say here that Apple is not a good company. Terrific company with great products, great future. But is the price right for this company at $100, which is the fair value? You probably want to get it at 85. I mean, you don't want to buy it at 100. You probably want to buy it a little bit lower than the fair value so you can get in and make some money. So at 126, it seems that all the success of this company is fully priced in. But again, this is not any advice to buy or sell the stock. As you know, this obviously isn't financial advice. I'm looking at a massive blue chip stock and sharing my own opinion. If you want to research the stock, use our platform, Stock MVP, on the screen right now. The details will be in the description and the pinned comment how to join. Use the code NASH10 for a 10% discount for life. Try it out for 14 days, risk-free. Don't like it, we'll give you a refund. And let me know below which other stocks you want us to review. Later.